Welcome everyone to our 6-monthly financial stability review. I have with me Jeff Baskand, Deputy Governor on my left, and Bernard Hodgetts, Head of Macro Financial Stability on my right. Our view is that the New Zealand financial system remains sound and risks to the system have reduced over the past 6 months. Internationally, growth momentum has continued and near-term risks have reduced. However, the New Zealand system remains exposed to elevated asset prices and high debt levels in a number of countries. Domestically, LVR policies have been in place since 2013 to address risks arising from rapid house price inflation and increasing household debt. These policies have helped to improve banking system resilience by substantially reducing the share of high LVR loans. Further, over the past 6 months, pressures in the housing market have continued to moderate as a result of the tightening of LVRs late last year, a more general firming in bank lending standards, and an increase in mortgage rates earlier this year. Going forward, housing market policies announced by the government are also expected to have a dampening effect on the housing market. So, in light of these developments, the Reserve Bank is undertaking a modest easing of the LVR restrictions, and from 1st of January, the LVR policy will require that no more than 15% of new mortgage lending to owner-occupiers can be at an LVR of more than 80%, and this is up from 10% currently, and no more than 5% of new mortgage lending to residential property investors can be at LVRs of more than 65%, which is up from 60% currently. The bank will monitor the impact of these changes and will only make further adjustments if financial stability risks remain contained. A cautious approach will reduce the risk of resurgence in the housing market or a deterioration in lending standards. Jeff.
Looking more broadly at the financial system, it appears sound when viewed through a number of lenses. The banking system has adequate capital with a satisfactory buffer over the minimum regulatory requirements, and it appears to be operating efficiently. The recovery in dairy commodity prices since mid-2016 has supported farm profitability. Recent stress tests suggest that banks are well positioned to withstand a severe economic downturn and operational risk events. Turning to regulatory developments, we've released 2 consultation papers on the review of bank capital requirements, and a 3rd paper on the measurement and aggregation of bank risk will be released shortly. The aim of the capital review is to ensure a very high level of confidence in the solvency of the banking system, while minimising complexity and compliance costs. The bank has also completed a review of the bank directors' attestation regime. We expect to elaborate on its findings and our response next year. We're making good progress in implementing a new dashboard approach to quarterly bank disclosures. This is expected to go live in May next year. Thank you.
Well, there's always uncertainty, so we can never be 100% sure with these things, and there's definitely still risks around the housing market, but this is why we're taking an incremental approach here. Also, we're given some confidence by the government policies, which we think are going to reinforce the moderation, things like the Bright Line test, restrictions on foreign buyers, the ring fencing of investor losses, and also the Kiwi Build program. they will be acting to moderate the market. And then, we also feel that bank credit standards, which have been reasonably tight, that's going to continue. In terms of, we do surveys of the banks and the levels of their credit standards, and we think they'll still be applying a pretty tough approach.
Studying closely what others are doing, examining whether this is a potential replacement for physical cash at some point in the future or not. It's part of a broader program of work that we're looking at our future currency models, both the distribution of cash as well as potentially electronic alternatives to it. But I couldn't give you anything more in terms of possible implications or conclusions of that. It's some time away.
It's an important area for the future. There's no doubt about that. But at present, the sort of central bank community, it's feeling their way as to, where is this going to converge in the long term. But I think it will make a difference.
I wonder if you could just sum up what the signal is you are sending to your average first home buyer out there in the market at the moment. What are you saying to them with today's actions that you're backing them and that you want to see them to get in there?
I think we'd say continue to be cautious that this market has moderated. We expect it to continue to moderate. This gives the banks a little bit more latitude in their lending decisions, but again, it's really only a change at the margin, and we don't expect it to have a significant effect at all.